Now my next guest is Eric Moore. He's a leading UK equity fund manager, and we've known Eric since he joined Bill Mott as co-manager of the Miton Income Fund in 2010, when it was known as the Sigma Income Fund. He subsequently has taken full responsibility for the fund when Bill retired a few years ago. Eric has previously co-managed the Fidelity UK Growth Fund, and he was a director of UK equities at Insight, where he was responsible for co-managing over $5 billion of institutional and retail money. Now, many of you here today will have some of your portfolio managed by Eric, because his fund forms a core holding of the equity portfolios that we put together. Eric's going to join us and to talk about his approach to how he manages his fund. So, warm welcome for Eric.
Thank you very much. Lovely to be here today. A bit of a tough act to follow after Naomi's speech. I'm going to give you, I hope, some hope that you shouldn't necessarily put everything in cash. So I run a UK equity income fund. First of all, a formality. I'm a regulated person. Everything I say is true, but none of it constitutes advice. The good news is, if you do want some advice, Stephen here and his colleagues, I'm sure will be delighted to help. Briefly, my biog. I work at a company called Miton. We are a small investment management company. That's all we do, is manage funds. We run altogether about 3 billion sterling's worth of assets. Specifically, I look after the Miton Income Fund, which is a UK equity income fund. I've been involved in that product for about 7 years, and I've been the lead manager on it for just approaching 3 years. So why am I here today? Well, I want to tell you about why income matters. So we've heard a lot about it's a very difficult environment out there, all sorts of moving forces in the world, but focusing on income, the money you can get in your hand from your investments, is a really good place to start. And I'm going to break that down and talk about the yield you get, and also trying to find growth in that income over time. So I'm going to talk about why that's important. I'm going to talk about how I go about finding that yield and that growth in income. And then I'm finally going to talk a little bit about what's actually in the fund right now. So when I think about the fund, I think really in terms of outputs. What does it give unit holders? What does it give our customers? Well, the first thing is it generates a yield of 4.1%. So a yield is the money you get in your hand. So 4.1%, it's like an interest rate. And 4.1 is quite a lot in a world where deposit rates are in the UK not even quarter of a percent. So that's a good starting point. And the fund yields a lot more than a lot of other funds out there. And I think that's a really good place to start. The second output, though, is that income that we pay has grown over time. So over the last 3 years, it's grown by 5% or more each of those years. And it's my ambition to carry on that level of growth. And the whole way I think about running the money is to say that yield plus the growth in dividend is what drives the total return. So in simple terms, a 4% yield growing at 5 should give you 9% per annum, other things being equal. And sometimes other things are equal. And if you look at what the fund has done over 3 years, well, 4 plus 5 is 9 times 3 is 27. And actually, well, the fund's done 25.9. So my maths hasn't quite worked, but it's nearly there. And I'm not one to blow my own trumpet, but as I'm here, you might forgive me, I hope, a small toot, which is to say that 25.9 compares to the all-share index, which has done, let me get my numbers right, has done 20, and the average equity fund, income fund, comparative funds to this one has done 19. So let's talk about why income matters, and that 4.1 and what that really means. So this is a slide with a wealth warning on it, just to show that I am a regulated person. This first slide, though, just shows what UK equities have done this millennium. And the answer is not very much. Okay, it's up 20%. So this is the index. So when on the news at 10 they say today in the city the all-share index was up 0.3%, this is what they're talking about. Okay, it's just an average of prices, of all the prices of all the companies that traded in London, turned into an average, weighted by size. And over the last 17 years, it's up 20% in total, which isn't very much. a bit disappointing. This probably underclubs how exciting it's been, though, because you can see there's been 2 periods where it's halved. So in 1999, looking back, that turns out that was the top of the tech boom. The market then halved to 2002, fought its way back to the top of the credit boom, then halved, and then it's been fighting its way back and pleasingly hasn't halved. But it's only up 20%. Now, the picture is radically different if you add in the dividends you would have received. So if you'd owned the index, but every time you get sent a dividend check from all these companies, you'd reinvested it, you get this line. So it's owning the same stocks, but counting the income you're getting out of them. And that's a much more cheering picture. So over that period, including the impact of taking the dividends you've received from all those companies and reinvesting it as you've gone along, then the market has more than doubled. So my point from looking at this is to say, well, dividends aren't just the icing on the cake. When you're thinking about shares, it's very tempting to say, well, I can buy this share on £1 because I think it's going to be worth £1.20 at some point. Actually, you should think about all the little bits of dividend you're going to get off those shares on the way through. Because increasingly, dividends haven't been just the icing on the cake, they've been the whole cake. So, well, this is easy then. I should just go and buy shares that yield the most, right? Because then I can collect more dividend checks, and that means I can grow my blue line faster. That's all I should do. Simples. Well, that's half the story. We also need to think about growth in dividends. So this is a slightly more tricky slide, but bear with me. It's really important to how I think about the world. So this chart breaks down the returns you've got from owning UK equities into decades. And the black line shows the average annual return you've had in a decade. So let's take the 1970s. There we are. Over the 1970s, you had an average annual return from owning equities of about 9%. Well, where did that come from? How did that return materialize? Well, the black bit was the dividend yield. So that was the money you got in your paw from owning shares. So that's the starting point. The blue bit, the turquoise bit above that, is the impact of the fact that those dividends grew over that period. There was some economic growth. Some of it was also inflation, but there's growth. Now, but the reason that the blue bar is above the black line is you lost a bit in the 70s through a derating, so shares got cheaper. If you scroll forward to the 80s, which was a great year to be in equities because you averaged about nearly 25% per annum, sensational, you got the black bit, you got your dividends, you got a lot of growth, it was the turquoise bit, and you also got a re-rating. You got the grey bit was a positive, so you had a re-rating, which has meant that investors were prepared to pay a higher price for that earnings stream, mainly in anticipation of higher growth. And so on and so forth for all the decades. But the key point is, if you look at the end, which I've put a bubble round, you can see that over all periods, you've had, this is looking a long way back, right? No short-termism here. We've looked over 50 years. And you can see that on average, from owning UK equities, you've had an average annual return of 11%. But that's come from the black bit, which is dividends, which has been reasonably constant through all those periods. So I think, well, if you're looking to how to build returns, you want to think about that income. That's always there. It's always positive, and that's a good foundation. But it's not enough. The black bit doesn't get you to the line. You also need to be accessing that growth in dividends. And the other thing that really strikes me, though, is that the valuation bit, whether the market has got more expensive or whether it's done badly and got cheaper, has kind of come out in the wash. So the grey bit you can hardly see. So when I think about how we're going to make money for unit holders out of equities, I look at this and I say, well, what I need the black bit, I need dividends. But just buying the highest yielding stocks, I can maybe increase the black column a little bit, but I'm not going to get you to the line. I need to be finding growth in dividends, because it's that growth in dividends that really powers your total return. And valuation, well, it's important, but it's probably less important than you think. And this is a big contrast to what I get in my inbox every day. I get thousands of emails saying, buy this share because it's on a PE of 13 times, and there's lots of scientific reasons for which think it should be on a PE of 16 times. And I say, well, that's the wrong way to look at it. What I want to know is what's the dividend yield and what's the outlook for growth in dividends. So when I think about investing, it's all about the dividend received and the growth in dividends over time, because that's what's going to drive your total return. The dividend is what you're going to get in your hand, and it's the dividend growth that will power the share price. And the process that I follow with the fund is then to try and maximise both parts of those equations. So I want good yield and good growth in dividend, because that will then, those are the twin drivers of your total return. So there's my magic formula. Dividend yield plus dividend growth is total return. And if you stop to think about it, well, why should a share go up? I mean, why should a share go from 100p to 200p? Well, probably because you're going to get more money out of it later. So it's all about trying to identify that growth. And just to prove that this is not an ivory tower, this is dividend growth in action. So this is the share price of Legal and General. And you can see on the first red arrow here, going back to halfway through 2010, the shares were about £1. And they paid you a dividend of just over 6p. So you can all do the maths. The dividend yield was about 6%. Now the shares now are about £2.50. Well, why is it more than doubled? Well, the dividend growth has been phenomenal. The dividend this company has paid is now 14p. So that dividend growth has powered that share price up. So the dividend you've had in your paw has been the 6%, and actually if you added up all the dividends you've received over that period, it adds up to about 40p. That's by the by. The point is, the yield, this stock has not got more expensive. It has doubled without getting dearer. It's because that dividend growth has powered that share price up. It's not necessarily that you've relied on someone saying that you've identified Legal and General and someone later has decided that it's worth more than you thought. It's that dividend growth has powered that share price up. So that's the sort of share we're trying to find. Because by analogy, that's what we want to do for our unit holders. So this chart shows, the bars show the dividend per unit that the fund has paid out to unit holders. So we want to collect a good and growing income so we can provide you a good and growing income, because that will drive your total return over time. So the bars show the dividend per share. The line shows the growth in dividends year on year. And just, beg your pardon. And just to be super clear, the naught here is sneakily halfway up the axis. So we've not always historically grown the dividend. It's always been paid. Since I've grabbed the reins of this fund about 3 years ago, I've really set out very clearly my ambition to grow the dividend at 5% per annum. So I hope if I'm lucky enough to see you in the future, these bars, blue bars, continue to go marching up slowly, but very steadily and very predictably by 5%. Not more, not less. Now, I can't guarantee that. It's not a target. If Godzilla eats Piccadilly, then sort of all bets are off. But notwithstanding a Godzilla moment, then I think that's a very achievable ambition. And I hope, and the point is that over time, you take the 4% yield and the 5% growth, and that will drive a nice total return. So, simple, right? We just buy things that yield, that can grow their dividends. Yeah. Tricky bit is, how do you find them? Okay, it is slightly easier said than done, and as Naomi's talked very eloquently about, there's quite a lot of negative forces around at work that make it a bit harder than it might first appear. So we need an investment philosophy and an investment process that's going to help us identify good and growing income. So this is what we do. We have basically a two-step process. The first bit is to try and come up with a coherent set of thoughts about what's going on in the world at large, the big picture stuff, and we call these themes. Okay, and this helps us identify areas where there is some growth. The second bit of the process then, though, is to then look bottom up. So when we've found companies that we think are exposed to these positive themes, to make sure when we're looking at individual stocks that those companies are capable of delivering a good dividend and a growing dividend over time. So it's a dual action process, top down with the themes and bottom up. The bottom-up process we call the traffic lights, because we're looking for 5 factors, which I'll talk about, that focus in on good and growing income. So starting with the top-down stuff, a theme. What's a theme? Well, a theme is just a real-world trend, something that's going on out there, something that affects all of us as consumers. It affects the way governments are thinking, affects the way people spend their money. Now, these are powerful because they help us find growth in what's otherwise a low-growth world. So we've heard a lot about the difficulties of central bank policy, government policies, too much debt. I would count these all as themes. So, debt is one of my themes, extreme monetary policy, public finances, brackets, the governments have no money. These are all important building blocks to how we think about the world and how we construct the fund. But some of these other themes are less economic, which is good because the world still turns, right? Despite zero interest rates and the confusions of central banks, the world still turns. People are still getting out of bed in the morning and doing stuff. And there's still lots of really interesting long-term growth drivers out there, kind of irrespective of what's going on with policy. So a great example is the aging population. So we know at the moment there's about 850 million people in the world over 65. And we also know that by 2050, that'll be 2 billion. And that's going to happen irrespective of Janet Yellen, irrespective of Donald Trump, irrespective of Chinese policy. That's happening anyway. So if we can find companies that are exposed to that structural growth, that theme, then we have got a better chance of finding sustainable long-run growth. So that's just a starting point. So then the question is, well, what does it mean? Well, it gets me thinking about things like pharmaceuticals. We've got people living longer. In the old days, I might be keeling over in a couple of years. Now there's a chance I'm going to live into my 80s. I will probably almost certainly have at least one acute medical condition. I will take a lot of pills. So this is a good structural long-term growth driver for pharmaceuticals. It also makes me think about the business I'm in, about savings, pensions and insurance, long-term structural growth there. It also makes me think again about governments and how they have made promises that they will not be able to keep. So each of these themes is just a starting point. Then it takes you down various alleys of exploration to think about what does it mean for certain sectors, and then in turn, ultimately, what does it mean for individual stocks. So 3 of these themes are economic, and I'll talk a little bit about, slightly building on what Naomi said about some of the economic picture at the moment. But a lot of these other themes kind of are happening regardless. Technology is obviously another one. The internet has changed everything. It's changed the way we shop, the way we consume, the way we work. We've seen it in all our own lives. It makes me think very nervously about retailers. So, Next just reported their results today, Marks & Spencer's. All these companies have quite an interesting yield, and people often say to me, oh, Eric, why don't you own Marks & Spencer's? They yield 5. Why don't you own Next? They yield more than that. Well, the problem is the internet is going to kill them, and they don't know what to do about it. So the point of these themes is to make sure you're swimming with the tide and not fight it, okay? So everything in the portfolio that I own ties into one of these 10 themes in one way or another. Now, I'm not going to go on about all of them. You'll be very happy to hear. But I maybe just want to talk a little bit about some of the economic stuff. It chimes in quite nicely with what Naomi was saying. And also, I think we're at quite an interesting point in markets. So this slide is the yield on the 10-year gilt. So the 10-year gilt is a government raising debt. It's a government IOU. And back in 1992, the government would pay you 10% for your money. And there's been a very, very persistent long-term trend down to less than 1% as on the aftermath of the referendum vote, and now flicked up a little bit. And some of this was part of the economic crisis, so the credit crunch and the extreme policy response that Naomi's talked about so eloquently, that we've seen interest rates cut, we've seen unorthodox monetary policy, quantitative easing, electronic money printing. These have all accelerated this downward shift in yields, but it was already happening. Okay, it's a longer term trend. And this has had implications for what sort of equities you've wanted to own over this period. Because as interest rates have fallen and fallen and fallen, and the returns on bonds have got lower and lower and lower, then during that period, if you own companies that paid a good dividend, better than maybe your bond or equivalent to your bond, but had bond-like characteristics, and could do well in a low growth and low inflation environment, because this is what the bond market's saying, growth is disappearing, inflation is disappearing. Otherwise, why would you lend anyone money at 1%? That would only make sense if there's no growth, you can't do anything better with your money, and there's no inflation to erode that return. So during that period, if you could own companies that would do well in that environment, like tobacco stocks, like food producers, like beverage companies with very stable income that aren't necessarily reliant on too much economic growth, all those companies did very well during that period. Also companies that benefited from the fact that money was really cheap. also did well during this period. So property stocks who rely on borrowing money to buy property, they also did well during that period. Now what's happened right now is the idea is maybe this great moderation period is coming to an end and we're entering maybe a reflationary period. So maybe inflation is starting to show a bit of a positive pulse. The last inflation number in the UK came out the other day was plus 2.3%. Now, that doesn't make a lot of sense of owning bonds, below that. That's giving you a negative return. The other thing that's happening is commodity prices have bounced. So the oil price is up in sterling terms, is up nearly 100% year on year. So that's feeding through into inflation. And there is also a little bit of economic growth around. It's not sensational, but on balance, growth is coming through a little bit better than people thought. So expectations are being revised upwards, which is positive. So there's flickers of life. And if there's life, then this is too low. And so just over the other interesting element is policy. So we've had this long period of record low interest rates, quantitative easing. The US Federal Reserve is beginning to raise rates. And there is, I think, in general, I'd put it as a collective head scratching as to whether quantitative easing has actually helped, and maybe it's time for other policy responses to pick up the baton a little bit, like fiscal policy, government spending money. I don't think the governments can spend a lot of money because they already have too much debt, but there is some suggestion that there will be a bit more, the governments will try to pull other levers rather than just interest rates. And all of these policies, like Mr. Trump himself, are probably, if anything, we don't know what it means, but they're probably inflationary. So over this last little period, the stuff that's benefited from the great moderation has done less well. So over the last few months, the stocks you've wanted to own have been things like banks, industrial stocks, and resource companies. Now the question is, though, is this just a little flick in a downtrend, or is this the beginning of a new uptrend and a reflation? Now, one thing that gives me a little bit of hope is this chart, which I've got as a build. So this chart, here we are, this chart. The stock market is supposed to be a barometer, not a weather vane. It's supposed to tell you what's going to happen, right? Not what's happening right now. What this number is, this line here shows what people thought in 2010 would happen to UK corporate earnings in 2012. So people back there in 2010, all the analysts and everyone who's covering all the companies in the stock market, they're all of them individually beavering away and thinking what's going to happen in 2 years' time. And then this number aggregates all that and brings it out as a number. So back in 2010, people were thinking, in 2012, there's going to be 10% earnings growth. And then, I'm afraid, reality gets in the way. And as we get to 2012, we actually get -7. So everyone got that wrong. The 2013 number, which started in 2011, people, despite what just happened, they look out and they think, well, 5%, oh no, maybe 10%, oh dear, no it's not, it's -7. Right? Scarred but unbowed, everyone does it again. And starts thinking in 2012 what 2014 is going to look like, comes up with a 10%, and I suppose it's a bit of a, it's not quite as bad, but we still end up with 0. So it's quite, I think there's another one. Yeah, then we get to 2015, people start thinking 10%, and actually we end up with -17. So this is pretty tragic on a lot of levels. First one is actually, this means we've had profit compression in the UK equity market. That's not good, because if you own shares, you own a share in those profits, and if the profits are shrinking, that's not good news. We need profits to pay the dividends, and I want dividends so I can give them back to you to drive the good and growing income. So this is bad news. It also, but are all these people just stupid? I mean, how can they get it so wrong? Well, there is some structural bias perhaps in people who forecast that they want to be a bit too positive. But the reason they've got it so wrong is because recovery has not come through. So it's been a continual process of disappointment that the world's going to recover that meets the reality that actually we're not recovering because there's too much debt and there's not enough economic growth. So far, so bad. Now, the good news is we look out to how the 2016 number has evolved, and actually was looking like it was following a similarly disappointing trajectory, and actually has improved. So 2016, we're actually going to see some earnings growth. And now, from 2015, when people are looking out to what they think of 2017, it looks like this. So we actually have positive earnings revisions. People are getting more optimistic about what profits companies can deliver. And it may yet be that we turn out to be disappointed, but I think this is a significant change. You know, built this up over many long years. There's been a disappointing process, but now it does look like the outlook for corporate profits is a little bit better than it has been in the past, and importantly, what we thought it was a year ago. And that is positive for equities. So that's the context in which we're trying to build a portfolio. So I've talked about the themes. And I want to talk a little bit about the bottom-up process, because if you're investing just on the big picture stuff, you can easily get unstuck. Because you can say, well, I found an interesting theme, say the aging population, and that means I want to just buy any company that has an exposure to that. And that's a bit like, I think, being a stamp collector and deciding you want to buy all Tibetan stamps. Actually, not all Tibetan stamps are going to be of value. So when you're looking at individual stocks, you want to make sure you can find those stocks that are going to deliver good and growing income. So I've got a 5-point plan about how to do that, which are affectionately known as the traffic lights, and I want green ones, not red ones. So why is a company going to be able to deliver good and growing income? Well, the first thing we need to see is an ability to grow its top line. So they can grow its sales. If you can't grow your sales, then in the long run, you're going to find it very hard to grow your dividends. Simple as that. The second one is about the margin structure of the business. So do unexpected cost increases get passed on to customers? If there's a bump in the road, and the road will be bumpy, are the wheels going to fall off and the dividend get cut? Or is there something robust enough about the business that means they'll be able to absorb that, at least partially, and carry on and pay the dividend? And what would make a company good like that? Well, it would be something to do with their assets, maybe their market share, their distribution, their management, their intellectual property. It could come from a variety of areas, but something that means they have some intrinsic robustness to them. So the dividend can get paid even in adversity. And hopefully grown. The third one is a bit management consulting speak, for which I apologise, but are management doing the right thing? And in my world, that means, do they care as much about a good and growing dividend as I do? So there are lots of good companies that might be thematically interesting to me and might have some other characteristics, but if they don't pay a dividend, then it's probably not for me. And if they're not concerned about growing their dividend, then it's also probably not for me. And growth is very important. There's a lot of companies at the moment, there is maybe a vogue for companies just to hand back money rather than invest for the future. So I want companies that are getting that balance right between a dividend now and also planting acorns that are going to turn into trees to deliver the dividend growth in the future. The fourth one is about the balance sheet of the companies we invest in. And again, we want to make sure that if there's a bump in the road, that the dividends will be safe. And history, I'm afraid, is littered with companies that look quite good and pay a nice dividend, but have a lot of debt. Then something bad happens, and then the dividend gets cut and the banks keep their money. So we're invested in equities, and we have to remember where we are in the pecking order, which is sadly at the bottom. So we want to make sure that our companies that we invest in are not too leveraged. So in general, we favour quite conservatively financed companies. And the last one is, are there low expectations in the share price? So this is not an exercise in collecting green traffic lights. This is about making money out of stocks and shares for our unit holders. So we need to make sure that we are buying companies where not all the green lights are already in the share price. And there's lots of examples of companies I'd love to own, but actually they're just too expensive. But being an income-focused fund and looking for companies with yield, that's probably going to keep me on the right path, because if a company has a decent yield, that's probably a good starting point from a value front. So that's the process. And I just want to just share a quote with you. This is a guy, Joel Greenblatt, who I don't know, but he's an American hedge fund manager, and this is one of my favourite quotes. And he says, "Choosing individual stocks without any idea of what you're looking for is like running through a dynamite factory with a burning match. You may live, but you're still an idiot." Now, being urbane Englishman, I might not put it quite the same way, but I certainly share his sentiments. So I hope I've set out that I'm very clear about what I'm trying to do, the importance of having a plan. We're looking for stocks with a good and growing income. How are we going to do that? We're trying to get the big picture right, and then we have a bottom-up process to make sure we're focusing on those stocks that can deliver. So just a quick peek at the fund and to see where this process and these thoughts get us. The fund, the sectors on the right are the areas where the fund is overweight and where we are pointing our arrows, if you like. So we have a lot in pharmaceuticals and biotechnology, in life insurance, which is really backing savings and long-term pensions, mining, which includes an allocation to gold stocks, telecoms, financial services, aerospace and defence, which is more defence than aerospace, and some in general industrials. And the areas we don't like are on the left, so we tend not to like UK consumer exposed areas like general retailers and travel and leisure, and we still are not that keen on banks or indeed UK house builders. Now, looking at the biggest stocks in the portfolio, this slide shows the top 15 holdings. So GlaxoSmithKline's at the top, 5% of the fund is invested in GlaxoSmithKline, and so on and so forth. So these are all FTSE 100 companies, with the exception of the one on the bottom, Highland Gold, which is an AIM-quoted gold miner. They're all very international. They're all very liquid, so I can get in and out. And many of them are household names. So for the fund to perform on an absolute basis, to go up in an absolute basis, these are the stocks we want to do well. So come on, Glaxo. Another way of skinning the cat, though, is to think about how's the fund built in compared to the shape of the all-share index. So this is where I'm taking active positions, if you like. So these are the stocks that need to do well for the fund to do better than the market as an average. So many of the stocks are the same, but just moved around in order. So Glaxo is still there. Come on, Glaxo. But Legal & General, Standard Life, BAE Systems, many of the same names. But also you see some smaller companies or mid-cap companies. In general, I'm not invested in small-cap, very small companies, but I have some mid-cap companies like Rentokil Initial, which is actually hopefully about to come back into the FTSE 100, and also some overseas stocks. So Sanofi and Merck & Co. are not quoted in the UK. To be a UK equity income fund, I have to own 80% of the fund in UK equities, not unreasonably, but that does mean you can do a bit of other stuff, and I'll use that flexibility to buy some overseas stocks in those areas that I really like. So you've already seen that I like pharmaceuticals. Rather than just owning tons and tons of Glaxo and tons of AstraZeneca, I think it makes more sense to have good holdings in those and supplement that with some overseas stocks where we can. So as I've said, a lot of these stocks are very international, and this has been a bit of a saver during the referendum process. So if you broke down the portfolio, you'd see that only 35%, only a third of the revenues of the portfolio actually come from the UK. So companies like GlaxoSmithKline, they're headquartered here, big shiny offices just outside Heathrow, but most of their business is overseas. Less than 10% of their revenues actually come from the UK, and so on and so forth through the portfolio. So it is a very global fund in terms of its exposure, but all through UK listed companies, UK corporate governance, UK accounting standards, and touch wood, it's a window on the world, but with UK governance structures. And this has been particularly helpful through Brexit, because it also means that these global companies, actually some of them don't pay their dividends in pounds. So AstraZeneca is a pharmaceutical company, Anglo-Swedish I should say by history, headquartered over here in the FTSE 100. They do all their financial reporting in dollars because they say their biggest market is America. Most of their sales are in dollars. They do everything in dollars, including declaring their dividend in dollars. Right? So if you add up all those stocks that declare their dividends in things other than pounds, it's 40% of the portfolio. So this has been quite handy as the pound has depreciated after the referendum. And I just want to bring that to life a little bit. So this weak sterling has really supported income growth in the short term and will continue to do so for a little bit longer. So AstraZeneca, I mentioned, I literally count in the dividends from the stocks we own as they get paid, and they get paid all through the year, and I literally count them in on a big spreadsheet. I'm not quite there in fingerless gloves at my desk, but it's pretty close to that. I'm literally ticking them off. So AstraZeneca, go back to August 2015, the interim dividend arrives, and I tick it off on my spreadsheet, and it's 90 cents, because it's a dollar-based company, even though it's over here. They do everything dollars, 90 cents. And I get my calculator out, and I work out, I look at the currency rate, 155, and I say, well, what's that for me? 58p, doing the maths. That goes in the pot, and that goes in the pot so I can pay it out in due course to our unit holders. Now scroll forward a year, still at my desk. The interim dividend check arrives, 90 cents per share, again, bit disappointed there's no growth there. I get my calculator out, what's the exchange rate? 130. So now that's 69p for me and for you. So it's gone from 58 to 69p. That's 19% growth. Okay, so we've earned that dividend, we've earned that growth in sterling. So AstraZeneca, at least temporarily, has become a good and growing income. That's a lot of income growth that we've had from AstraZeneca. Now this is just maths. It's just maths on the currency rate. It's not necessarily a particular skill on my part, I must admit. But we're still going to continue to have that benefit a little bit longer, because the currency rate right now is 124. So all the overseas dividends I'm collecting at the moment are still growing nicely year on year when brought back to sterling. And all the way through to June 24, when the pound fell, we'll still have that benefit coming through. So that's been a benefit and a headwind for delivering dividend growth this year. It's going to continue to be. But the main point is that although this is a UK equity income fund, the sources of dividend and the sources of dividend growth are quite global, which I find a comfort. And in summary, I often get asked, so Eric, you talk about yielding more than 4, growing that dividend at 5. Does that mean you only own shares that yield 4, growing their dividend at 5? And I go, no, it's a bit more complicated than that. And actually, there aren't that many shares in the market that yield 4, growing at 5. It's surprisingly rare. But the point is, the fund is a collective. It's a pooled vehicle, and it's built of lots of individual ingredients. So my boss doesn't like this analogy very much, but I think the Miton Income Fund is like a bottle of blended whiskey. So a blend of whiskey is made up of individual malt ingredients, and some of those ingredients, one by individually, can be a little bit tough on the palate. They're very strong and they're one-directional. And can be a bit like that with the Miton Income Fund. So I've got some stocks that I'd say are a little bit peaty, like GlaxoSmithKline. That has a great dividend yield. It yields nearly 6%, but is not growing its dividend at the moment. I believe it will in time, but at the moment there's not a lot of dividend growth there. So that's a bit peaty. I've got stocks that are kind of the obverse. So St James's Place, I say that's a bit sharp. They only yield about 3, but they're growing their dividend at 20%. So the growth is great, although the yield's not so good. I've got some stocks which are a bit spicy. So Man Group, that has great yield characteristics, but is quite a volatile share. And overall, I don't really like volatility, so I'd say that's a bit spicy. And I did say this was a bit of a cheesy slide, so indulge me. I've got some stocks which are a bit smoky, like Imperial Brands, formerly known as Imperial Tobacco, yields 5, growing its dividend at 10, but ultimately will not be able to grow that forever. But the point is, you put that all together, and like single malts going into a blend, that you end up with a smooth finish, and you end up with a set of outcomes that are really quite pleasant. So you've got a fund that invests in very liquid companies. We've got very good performance combined with low volatility. So despite owning some spicy stocks, this fund is less volatile than the median fund in the sector and less volatile than the index average, and has very attractive income characteristics, 4.1% yield, 5% growth historically, personal ambition to carry on that 5% growth. And if you could get those ingredients in one stock, you'd probably want to buy that share. Thank you very much.
Does anyone have any questions for Eric?
Thank you. Very, very interesting. I'm not sure if the question is for you or for others who will come. Steve, you can adjudicate. dividends and growth is all a function of their sustainability
Yep.
as entities. Can you talk about artificial intelligence and robotics in the context of that, please?
Yeah, that's a big question. So, taking it back to my process, one of our themes is technology, and that will cut across a lot of sectors. There's been a lot said about AI. It's in its early stages. I actually studied a bit of cognitive science when I was at Edinburgh, but it's still very early stage. But you are seeing a lot of changes in work as a result of it, and you're already seeing a lot of manual tasks being replaced by robots, and you're beginning to see tasks that can be formulated that are white collar, that require some judgment, but are constrained, will ultimately be replaced by technology. So back offices within financial services will ultimately be replaced by algorithms. You might not want to encourage your children to become accountants or lawyers because ultimately an algo can do it. There are algos who want to do my job. Okay, so does this mean that we're all going to be unemployed? Well, perhaps, but I would cast my mind back, hundreds of years ago, people used to bemoan the fact that there's going to be mass unemployment because there won't be rivermen taking people on boats across the Thames. And that was bad news if you were a riverman, but no one really misses them. So I think probably there will be evolution. It would be interesting to invest in those companies that are in those sweet spots or are helping out on robotics, artificial intelligence. They're still very small and they're still very early days. And the ones I see that might be interesting from that theme, they don't really work on my traffic lights because they're not capable of providing good and growing income at this stage.
Thanks. What is your average rate of turnover in a year?
So the fund will turn over about 10% a quarter, so that averages about 40% a year. So because I'm looking for income, looking for dividends, I've got a core of the portfolio broadly stays the same. A lot of my themes are long duration, so they don't really move around that much. That's why they're powerful. I can invest behind them. But because I'm always looking for income, I can be a bit calendar sensitive of looking to when to own lots of a company ahead of its income payment. So a good example would be I own ITV and I've owned it for a long time. Won't go into why, but I can tell you that in a month's time they're going to pay their final dividend and a special dividend. So I have cranked up my exposure to ITV to catch that dividend. Once I've had it, I might pare it back a bit. And that means the turnover does go up a little bit.
Thank you very much.
Anyone else? Yes.
One of the criteria that you said you looked at was the company's ability to increase its dividend. What incentive does any individual company have to increase that dividend? Or what motivates them to do this?
The inverse, I suppose, is if they cut their dividend, then usually the chief executive's head's on a stick outside the building. So they are motivated usually to pay the dividend. But some of it is choice and culture. So I think in America, companies are less predisposed to pay dividends and talk more about reinvesting for growth. And then that would get you back to my middle traffic light about do management care about good and growing income as much as I do. So not all companies think that way. But companies, I think, are, a lot of companies are cognizant of the fact that they want that the money that they are investing is shareholders' money. So they do feel a responsibility to pay a dividend, but not all companies will grow it. And there's a great example at the moment in the mining sector, which has been very volatile. These companies like Rio Tinto and BHP Billiton, massive companies, they set out their stall to say, we're so big and so diverse that we can buck the cycle in commodity prices and pay a progressive dividend come what may, i.e. we will grow it even if iron ore prices are tanking. And this got them into a terrible mess because iron ore prices tanked, China slowed down, and they couldn't pay a progressive dividend. Then they had to cut the dividend, and now they're back to the drawing board. So sometimes it's not appropriate to grow your dividend. It depends on the sort of business you're in. But managements on the whole, though, do think that a dividend is part of what they're promised to shareholders. It is shareholders' money.
Okay, last one. have you been in, or are you currently in, the stealthy bubble that I call purple bricks? And have you come out of that and gone to Rightmove?
Excellent question. The fund does not and has not ever owned Purple Bricks, which, for those of you might not know, is a online estate agency business. It is very highly rated, so thematically it's quite interesting. Estate agents' business has not been disrupted by technology. They still earn an ad valorem fee, typically 2%, even though house prices are, a double from where they were a year ago. The fees are very fat, and Purple Bricks are a disruptor coming along with the technology to try and eat some of the estate agent's lunch, which is a seductive idea. Sadly, the company evaluation is way in excess of its profitability, certainly now or indeed possibly in the future. If Purple Bricks works, the barriers to entry are very low. I think it's very bad news for estate agents, but Purple Bricks will not necessarily have the field to themselves. I am interested in internet businesses, in platforms, so the fund does have a holding in moneysupermarket.com, which is a price comparison website. Very interesting long-term growth drivers there as people shop around more and brand loyalty reduces. That company actually looks okay on conventional multiples, has a dividend yield of more than 3%, growing its dividend, and also in Zoopla. Not Rightmove.
Thank you, Eric.
Thank you very much. Thank you for your time.
That was a great insight into process and strategy, and on behalf of all the investors that are with you, Eric, keep up the good work. Just one quickie on Purple Bricks. We were with a leading fund manager a few weeks ago, and he's heavily buying Purple Bricks, which we were quite shocked with. And I've also had personal involvement with Purple Bricks, and I found I don't think there's anybody here from Purple Bricks, but I found their service absolutely appalling. And so I don't know, why or how the seller was continuing to use them. So it's quite an interesting comment.